Saw a couple of studies this week released late 2020 about personal loans, car loans, credit card debt that I wanted to share, just kind of review, give you an idea of what's going on. Let's look first of all at the Federal Reserve statistical release. Shows that we've got the interest rates on credit cards and personal loans and car loans, how they're changing over the last year or 3 years up to 5 years. See right there, car loans really haven't changed a whole lot in the last 5 years. They've gone up a half a percentage point, a little more than that. They've actually come down in the last last year or two. Not surprising with the everything going on with the pandemic, that they came down. Now, credit card interest rates. 5 years ago, they were sitting at about 13.5%, and now they are approaching 16.5%. So 2.5 to 3 percentage points higher is what we're seeing. And then you've got personal loans, which really haven't changed a whole lot. They're just slightly down or almost the same as they were 4 or 5 years ago. That's where we're at with the interest rates. Now let's take a look at actual usage and see what we're seeing and trends. So if you look here on this 2021 credit market kind of projections that TransUnion has, we look down here and we see that compared to the first quarter 2020, 2021, we're still down as far as credit cards usage and personal loans originations. We just are not borrowing that much on credit cards or on personal loans compared to where we were a year ago. Now, not surprising, from the first quarter of 2020 to the second quarter, so from January, February, and March, going into April, May, June, when real economic hit from the pandemic was upon us, we saw a major decline in credit card usage. Everybody pulled back, paid off some of their credit card debts actually with their stimulus checks, and stopped using credit cards so much. It's very common at the beginning of recessions. We all of a sudden realize, hey, I don't need to be spending all my money on all this frivolous stuff or non-essentials or on wants. We need to focus on our needs. That's pretty normal. Personal loans also plummeted. Two things went up. Your car loans went up over year to year. Here's what happened from this year compared to last year. We are up 8% as far as car loans and almost 14% as far as home loans or mortgages. Not surprising again, because the interest rates are so low on home loans and refinancing. It's just been we've skyrocketed. Most real estate markets around the country are seeing jumps in prices because everybody wants to refinance at these low rates. And so you have a high demand for homes because of the low interest rates, and the supply is not keeping up, and so prices are going to go up because of supply and demand. Now, what about credit cards and personal loans? They took the hit. They are TransUnion expects them to jump again back to pretty much where they were, almost as far as credit card usage. By the end of June 2021, they're going to increase 65, almost 65% compared to where they were in 2020. Not surprising, because it was, when you compare anything to nothing, anything is going to look huge. And we just almost had nothing in credit card usage a year ago, 2020. That's going to get back almost to normal. What is concerning, though, is the use of personal loans. Those interest rates were at 10% that we saw earlier. 10% interest loans, and we're going to see an increase, not just back up to where they were a year ago in 2020, or at the beginning of, even before the pandemic, but we're going to see an increase going forward. And this was what TransUnion projected even before the pandemic, COVID hit the scene in late 2019, is that we're going to continue to see an increase in personal loans. Problem? Well, at 10%, that's pretty high. It's not a killer interest rate depending on how much you're borrowing, but the problem is that includes the lower interest rate loans, signature loans through credit unions and banks, but it also includes some of those personal loans you can find at those corner finance stores where the interest rates might be 20% or 30% or even higher. That when a household or an individual gets into that kind of loan, whether it's $500 or $1,000 or $5,000, because they've heard, hey, this company says that it can help build my credit. It is so expensive. It's such an expensive way to build credit. Please look at other options. Do check us out, our resources here, where you'll find the list of these resources that we've been talking about, these 2 studies and statistics, as well as moneyfit.org. Go to our academy and find ways to build your credit and to pay off your debt.